Hi everyone, welcome back to Tax Tutoring and Training. My name's Hannah, and in today's lesson, we're going to be going over the common types of adjustments to income. And these will be reported on your income tax return, and we're basically seeing how we can take a lower gross income so that you can be taxed at a lower rate. As always, there's guided notes linked in the description down below. So if you want to stay engaged, follow along, and complete some practice to see if you've learned anything, make sure to check those out. All right, let's get started. So, adjustments. Adjustments are basically ways that you can take an expense that you have and subtract that expense from your gross income so that your gross income or total income is lowered, meaning that you'll be taxed at a lower at the percentage you'll be taxed at will end up with lower amount of total tax because what you're being taxed with is lower than what it normally would be without adjustments. In the next few lessons, we're going to be going over standard and itemized deductions, and these are things that you would do after you take your adjustments. So adjustments before deductions in order to get your total adjusted gross income. Okay, so what are some common types of adjustments that we're going to be going over today with? Well, that includes self-employment income and tax, self-employed health insurance, early withdrawals, penalties, alimony, contributions to an IRA or an HSA, student loan interest, or jury duty income. The first type of expenses that we are able to adjust income with are educator expenses. And eligible educators can deduct up to $300 of qualified expenses. Now, what makes you an eligible educator? Well, that's K through 12 teachers that have taught for a minimum of 900 hours during the school year. And if they paid $300 or less, they can deduct what they paid for expenses that they put towards the classroom. And these could include things like books, supplies, other materials such as like Kleenex. I know because it's been a big thing since COVID happened. Lysol, anything, any like PPE stuff that they'd use in the classroom, that would also help. And equipment, including computer equipment or software equipment, also counts. The expenses that don't qualify include if you homeschool or supplies for health courses or non-athletic supplies for if you teach phys ed. And if the taxpayer received a reimbursement, because sometimes the school will actually pay for these supplies and reimburse the teachers if they paid their own money for it. If the teachers got a reimbursement, then they can't deduct these expenses because why would you deduct it if it isn't your money being paid towards the expenses? That's just kind of where we're at. Okay. So, self-employment tax, how are we handling it? Well, a portion of self-employment tax can be subtracted from the total income. The self-employment tax is usually automatically calculated from the Schedule SE, and this will be done in our TaxSlayer software, or if you use another tax computing software, that'll also work too. But the Volunteer Income Tax Assistance Program, which is what I'm training you to be certified for, we normally use TaxSlayer. And the software will automatically calculate how much of that self-employment tax will be able to be deducted from the adjusted gross income. And self-employed health insurance is a different deduction. And self-employed health insurance is basically where taxpayers can deduct the cost of their health insurance paid as a deduction from their gross income. And it is in scope for returns without the premium tax calculations. If the taxpayer has a spouse that qualifies for the deduction when married filing jointly, then they can share that deduction and it'll be okay. Okay. Now, going into how taking adjustments for alimony paid. And if you don't know what alimony is, early withdrawal. Sorry, my bad. I got ahead of myself. Penalties for early withdrawal. So sometimes you might have certain accounts such as like certificates of deposits or CDs or bonds or what is it? Or bonds or um, sorry, IRAs or retirement plans. There we go. retirement plans, and where you have this set amount where you can't withdraw your money early. And if you do, it results in a really high tax. Well, if you do end up withdrawing that early, then you would receive Form 1099 interest or Form 1099 OID, and that penalty amount would be entered on the interest statement in TaxSlayer. But you can deduct. So, say I had a CD for 5,000, and I had to take that out early, 1 year early. Then I would claim that 5,000 as an adjustment to income, meaning that it would go off my income. However, I would still have to pay the really high tax on it. It's just kind of like a weird thing, but yeah, that's how it works. Okay, now we're getting to alimony. If you don't know what alimony is, it's basically what money has to be paid to the other spouse in a divorce settlement. So if two spouses are separating, sometimes they'll go to court, and one spouse who might have a higher income will have to pay the other spouse, and that's alimony. So, and there's two types of alimony kind of situations that we'll handle, and that's pre-2019 divorces or post-2019 divorces. Alimony paid before or on December 31st, 2018, or before 2019 is deductible. So any alimony that is paid, that you paid to your spouse that you separated from before 2019, you would be able to deduct that as an adjustment to income. And this could be considered direct payments or payments to cover expenses such as medical bills, housing costs, etc. But if your divorce was after 2019, then then any alimony paid is no longer deductible. Don't confuse alimony payments with child support payments, though. Child support payments are automatically not deductible. Okay, and here's a few test things that you can do to determine if the taxpayer has to pay deductible alimony. And these include if payments are required by a divorce settlement or separation instrument, they don't file a joint return, payments in cash, payment isn't designated as in the instrument as not alimony, spouses are legally separated under decree of divorce, or separate maintenance aren't members of the same household, payments aren't required after the death of the recipient spouse, payment isn't treated as child support. These payments are deductible by the taxpayer and includable in income by the recipient. All right. So now we're looking at, can you deduct or can you adjust your income if you contributed to an IRA? Now, only contributions to IRAs are deductible. So IRAs are really special. IRA stands for Individual Retirement Account, if you didn't know. But IRAs are special in that it's a retirement plan where you put your money into it now and it becomes tax deferred, meaning you don't have to pay tax on it now, which is why whatever you put in there, it becomes an adjustment to your income because you don't want to pay tax now. You pay it when you take the distributions out when you're old, when you're like 65, I think, is when they start letting you pull IRA distributions. And that's when you would pay the tax as an income tax because you're taking it out. So only contributions to traditional IRAs are deductible, and taxpayers may contribute and deduct up to $6,000, $7,000 if you're 15 up. So there's a limit on how much you can put in each IRA, and that's $6,000, meaning you can only deduct up to $6,000. So say you put all $6,000 in there, you'd be able to deduct all that $6,000. If you put $5,000 in there, you'd be able to deduct $5,000 because that's how much you're putting in the IRA. Contributions cannot be more than the taxpayer's yearly compensation. This makes sense. You can't put more in an IRA than you actually have to live with. That just doesn't work. And deductions can be phased out depending on income. MAGI stands for, sorry. I can't think of it. But depending income, MAGI, that's kind of like your adjusted gross income. Sorry, I can't think of what the M stands for, but it's adjusted gross income. Filing status and availability for employer-provided retirement plans. So the IRA deduction worksheet in Form 1040 instructs you on how to add IRA contributions. And in order to do this, you'd go to the Adjustments tab and click Begin on the IRA deduction line. And that's how you would do it in the TaxSlayer software. Okay, health savings accounts, or HSAs. So how are we supposed to make an adjustment to gross income when you have expenses paid to a health savings account? So in the taxpayer's intake and interview quality review sheet, they will check yes or no to if they had an HSA box. If the taxpayer or spouse's form W-2 form contains a code W in box 12 for employer contributions, the taxpayer or spouse should have a form 1099 SA with an X in the box showing the distributions from the HSA. In 2024, In 2024, the contribution limits is a family plan is 8,300, self-only plan is 4,150. And then you can add an additional 1,000 to deduct if the owner is age 55 or over at the end of the year. So if you paid this, you'd be able to deduct it from your adjusted gross income. Okay. Student loan interest. We're almost done, guys, I promise. But student loan interest, this is gradually phased out or eliminated based on the taxpayer's filing status or modified adjusted gross income. There we go. That's what the M stands for. Sorry. What this basically means is usually it'll be canceled depending on their filing status, but generally student loan interest can be taken by up to $2,500 if they are head of household and single with an AGI of less than 75,000, or they're married filing jointly with an AGI of less than 155,000. And in this case, they'll be able to take $2,500 out of, or they'll be able to deduct it from their gross income. And what qualifies as student loan interest qualification? So, and again, I just want to remind you, we're only deducting the interest on the loan, not the loan itself. And the loan must be legally liable to the taxpayer, meaning it must be issued to the taxpayer and used solely to pay education expenses. And this could be tuition, books, rent, etc., stuff to live on school or to do school, basically, in a secondary education institute. The loan can't be from a related person or made under a qualified employer plan either. And a taxpayer can deduct interest paid during the remaining period of the student loan. So you can only deduct it during the period of the loan, basically. And the student must be the taxpayer, spouse, or the taxpayer's dependent, basically the one that the loan is issued to, except if they married filing jointly, had a gross income over the exception amount. And they must have enrolled at least half-time in a program leading to a degree or other credential, aka a post-secondary education. And the last type of expense that we're going to be going over with that adjusts your gross income is jury duty. And jury duty pay received by taxpayers is included in the other income section. If the taxpayer, and then where the adjustment comes in is if the taxpayer turned over any of their jury duty pay to their employer because the employer continued to pay the taxpayer while they served on duty, meaning that your employer says, okay, you can go to jury duty, but whatever money you make serving on the jury, you have to give me that in order for me to give you your pay for being here, basically, is what that means. If the employer did that, then you would include the amount that the taxpayer gave the employer, so their jury duty pay, as an income adjustment on Schedule 1. Because you wouldn't want to pay tax on that as income because it's just going to your employer. So you take it as a deduction. If you're a taxpayer and wanting to seek help from the Volunteer Income Tax Assistance Program or and any of our VITA sites located, we want to let you know that other interest to income on Form 1040, such as the self-employed health insurance deduction with premium tax calculations, self-employed SEP, simple, and qualified plans, certain business expenses of performing artists, domestic production activities deduction, and Form 108606 non-deductible IRAs are out of scope, and we encourage you to seek help from a professional taxpayer if you have anything that qualifies under these standards. All right, guys, thank you so much for listening. In future lessons, we're going to be going over itemized and standard deductions, which is basically extra money you can subtract from your AGI in order to lower how much total tax you need to pay. Please stay tuned, and thanks for listening. Bye, guys.